Every second, banks around the world are quietly doing something that sounds illegal. They create money, not by printing in some hidden vault, but by typing it into existence. No gold, no vaults, no magician's wand, just a few keystrokes and poof. Money, created from nothing, and they get rich doing it. And guess what? This system isn't broken. It's doing exactly what it was designed to do: make the rich richer and keep you working. Today, we're breaking down how banks create money from thin air, how the system started, and how it affects you every single day. So, without further delay, let's get into it. Because trust me, what's behind it is not what they teach in school. Let's clear something up. The paper money printed by governments, that's just the tip of the financial iceberg. In fact, physical cash makes up less than 3% of the total money supply. Money supply means the total amount of money in circulation. The rest, it lives inside computers, floating around as digits, created by banks every time they make loans. You might think money comes from hard work, taxes, or building businesses. That's just half the story, because most money in existence was simply borrowed into existence. Now imagine this: you walk into a bank, apply for a loan, a few signatures, and boom, $100,000 shows up in your account. No one moved that cash from a vault. It was typed into life, and suddenly you owe real debt for that money. Flashback from barter to banking. To understand this madness, let's rewind. Once upon a time, people used to barter. A farmer would trade grain for tools. The barter was messy. Try swiping a goat for a haircut. Awkward, right? So we moved to commodities like salt, cattle, and eventually gold and silver. Gold was shiny, scarce, and portable, but lugging it around, not ideal. That's where goldsmiths stepped in. People deposited gold for safekeeping and got paper receipts. Those receipts became early paper money. Then goldsmiths got clever. They realized people rarely came to withdraw their gold, so they printed more receipts than they had gold. A little trick called fractional honesty. And just like that, banking evolved from storing wealth to creating illusion, one step removed from sleight of hand. Chapter 3. Fast forward to today, banks still play the game, just with better PR and shinier suits. It's called fractional reserve banking. Banks keep only a small fraction of your money, say 10%, and lend out the rest. Deposit $1,000, they keep $100, lend $900, that $900 lands in someone else's account, and 90% of that gets lent again. Layer by layer, the money supply balloons, all from your original deposit. Let that sink in. $1 can multiply into 9. No gold, no labor, just spreadsheets and confidence. But here's the kicker: they're not lending your money, they're just creating new money for someone else and charging interest on it. A few clicks, a new loan, and boom, the economy grows on paper. Chapter 4. Now, here's where it gets spicy. Every time a loan is made, debt is created. And to repay the loan plus interest, even more money needs to exist in the future. That means more borrowing, more money creation. It's like feeding caffeine to a racehorse that's already sprinting. This debt driven cycle fuels economic growth, but also inflation. From year 2000 to now, the cost of an average US home has nearly doubled. Your rent goes up, groceries go up, but your salary, not so much. That's not a glitch in the system. That is the system. Now, here's the cheekiest part. When you take out a loan, the bank doesn't lend someone else's savings. It creates brand new money, then charges you interest for the privilege. Imagine opening a Word doc, typing $100,000, hitting save, and then making someone pay you monthly just because you typed it first. You do the work, they collect the rent, and when you finally pay it off, the money vanishes from the system. But the interest the banks cut stays. Clean profit, minimal risk. It's like renting out a house that never existed and still getting paid. Sounds genius. Chapter 6. So, what happens when banks run low on reserves? They turn to the central bank, like teenagers asking dad for more gas money. The government steps in by issuing bonds, fancy IOUs. Banks or big institutions buy them, and that bond money flows into the economy, into salaries, businesses, spending. But here's the kicker: governments rarely earn more than they spend, so they issue more bonds, more debt, more borrowing. It's like trying to pay off your MasterCard by maxing out your Visa, except this time it's your future tax money footing the bill. Chapter 7. The financial system isn't built on gold or productivity, it's built on trust, debt, and vibes. As long as people keep borrowing and believing, the machine keeps humming. But if you don't understand it, you're not in the game, you are the game. Remember, banks don't need trees to grow money, they just need you to sign the dotted line. If this pulled back the curtain for you, feel free to subscribe for more such videos on finance and economics, because in a world built on illusions, the clearest vision wins. Now, with all of that being said, thanks for watching, and I'll see you in the next one.